Hey, what's up, UA crew? Today we're talking about how to get a loan to buy a business. This is Ryan from Unconventional Acquisitions, where we build wealth and businesses unconventionally. If you like what you see and you're getting value, definitely hit the thumbs up button. Make sure to subscribe to us so you get the new content we put out every single week. And if you have any questions, please drop them in the comments. Here we go.
How often do you see people stretch to buy a business the first time? And two is, what information do you have on default rates? Like, how often do any of these loans go sideways at these early stage points? The data that I was just pulling up that I looked at basically says that on average for SBA loans, these are loans, let's say below $2 million, the rates, and it looks like a little tough to pull the data depending on how you do it, but the rates seem to be a default rate of anywhere from 3 to 15%. So like a very low default rate. Can you talk to me a little bit about that?
Sure. Your first question. So how often do I see people, stretching or maybe reaching on the size of a business, right? It can happen somewhat often, I think, and it all lends itself back to some misconceptions about SBA lending. If you go into it with the mindset that, the SBA guarantees a loan of up to 75%, and everybody and anybody qualifies for an SBA loan, then, those are the folks that I typically get where their net worth, they may be targeting a $3 million business, and their net worth, would be more in line with them targeting something around, $1 million or so. And when I point to net worth and it being related to the size of the business that you can acquire, I'm talking about what sort of assets you have. When we talk about business acquisitions, and we're not talking about many opportunities where you have real estate involved in a transaction, or you have tangible assets that can help collateralize a transaction. I mean, the beauty of the SBA is, yes, it mitigates, or it helps mitigate exposure for the lender. That's the design of the program. That's what allows banks to make these loans to begin with. But as loans tick upwards, as the size of these transactions get larger, there's more risk associated with them. And the SBA actually requires the bank to look to you personally to help mitigate exposure by way of your personal collateral. Just touching on something Natasha said with her real estate investments, something like that is going to come into the fold if she were to consider using leverage or using an SBA loan. When you have folks that come to me and they don't have much outside income, and they don't have assets, and they don't have long-term investments, rainy day funds, and you look at their bottom line net worth and it's pretty minimal, and they want to target a $3 million business because they have $350,000 in the bank, they're reaching. Okay, scale it back a little bit. It's going to be very, very difficult for you to find a lender that's going to get comfortable with issuing a loan of that size. I could provide much more detail on that, but I feel like that's probably, the best broad answer, I suppose, with a few details in there as it relates to clients trying to reach on financing.
So I know I'm about to interrupt you before you answer the second question, but what are the parameters that you find most normal for the loans that you issue? How much cash do they have to have to their loans? And, you mentioned 75% of the purchase price by the SBA they'll theoretically take. I've definitely heard variations on that number. So what are the guideposts, or what are the parameters? How can we put up some bowling lanes so people know if a deal is or is not within their net worth, credit score, and the feasibility of an SBA loan?
Absolutely. So that's, again, beauty of the SBA, misconceptions, all this stuff. We'll swirl around all my answers. I mean, one of the tremendous advantages of SBA 7A, and I'm just going to cater the conversation to 7A, because if we're talking about acquisitions, that's the umbrella of the program that you're going to utilize 99% of the time, unless there's a hefty real estate or equipment element to the opportunity, and then you might delve into a little bit of 504. But 7A, there's no other program in existence, no other conventional loan product that allows for up to 90% loan to value. So there's the potential for you as the buyer, you as the borrower, to only need to bring 10% down, 10% of your purchase price or your project cost to be able to achieve that financing. There's some very special circumstances where you could limit that 10% and bring that number below 10%, but you're going to have some pretty hefty seller participation which means note on complete standby. They can't get a payment for an extent until the loan is paid off. And even still, you're finding these days most lenders want buyers to have at least 10%. And you're also going to want to have some post-transaction liquidity. You can't be emptying the tank with that 10%. When I talk about net worth, when I talk about assets, long-term investments, rainy day funds, your cash, your liquidity, how you get there with your 10%, whether you're liquidating stocks, whether you're using your checkings or your savings, or you're rolling over a 401k, don't wipe yourself out. That's not going to be ideal when you're trying to achieve SBA finance to purchase a business. So 90% loan to value, 10%, a little bit of buffer there for some post-transaction liquidity. Business takeovers, acquisitions, they're tough in those first 3 to 6 to 9 or 12 months. So the banks want you to be able to, have an ability to support yourself if things take a little bit longer to really stabilize under new ownership. What was the second portion of your question there, Codie?
Well, it was just any other guardrails you could provide. So like, for instance, credit score. What are you seeing these days for people's credit that they need to have across your loan portfolio?
Right. So again, something you need to realize about SBA loans is SBA is not the lender. The bank is a lender. It's a conventional loan. It's backed by the SBA again. So, when you call up a bank or you speak with a bank and they tell you that you don't qualify for SBA lending, 99% of the time, that's not true. It's not the SBA deciding that you do not qualify. The SBA doesn't really have limitations on credit score. They don't have timelines for how long you need to separate yourself from a bankruptcy. That's all within bank parameters. They decide where they want minimum credit scores to be, how long of a separation between bankruptcies. The SBA has very, black and white, strict guidelines, rules and regulations that the lender must adhere to for that loan to be guaranteed by the SBA. Now, if I'm talking about, averages or what most lenders that I utilize, what they want to see, I can't even necessarily say it's an exact credit score. We don't want major issues on your credit. We don't want you, having late payments, lates on your mortgage, no tax liens, bankruptcies, okay, but we need to explain them. How far have you separated yourself from that bankruptcy? What happened? Was it personal? Was it business? Even folks who have felonies can, albeit the SBA has to approve it themselves, they can achieve SBA loans. So if you've had a misdemeanor or a felony, we can still submit to the SBA and ask for their approval for you to be able to be made a loan. And again, you still have to be a qualified borrower for that given bank. So that's something to really understand. Every lender's appetite is different. Not many banks out there, many banks out there don't like to engage in business acquisitions. It's just not within their appetite because these are riskier opportunities. And again, they typically lack collateral, and that's just not for everybody. But when you work with some of the top SBA lenders, some of the nationwide folks that are top 10, top 25, they need to lend money to make money, and they've recognized that acquisitions, it's a booming industry, and they'll play within that space. That's when we start to talk about individuals and how they can mitigate risks that are associated with businesses, or how stronger businesses can help weaker borrowers, all that sort of stuff. But ultimately, it's about fitting within a bank's appetite to lend as it relates to, who does or does not qualify for a loan.
So totally understand. So how about answer this question? What's the variance on some of these? So, you guys work with lenders all across the country and have lots of different relationships that vary depending on industry and geography. So is there massive variance in, what banks will allow for credit score or past history or allowances for net worth? Or do you find that they trade at a relatively tighter band?
Well, I will say this, there's definitely variances across lenders. And that's one of our specialties, kind of knowing who has the appetite for what, or when we look at a given opportunity and we associate risk, I know who to avoid and who to, funnel these opportunities through. I think, again, when you work with top SBA preferred nationwide lenders, there's not going to be as much variance. There may be some slight differences in, who has a 650 minimum and who wants folks at 680. Because I certainly have banks who play, within, those tight margins. I have some banks where they don't care about credit score at all. If it's explainable, if it's not major, if somebody had a blip on the radar and that's what's affecting their score, but we can tell a good story and get them past that hurdle. Score doesn't necessarily matter. There's other strengths that can mitigate that sort of weakness. For us, again, when I'm talking about acquisitions, I have 5 go-to resources that'll consider these opportunities. There's certainly more banks that will ultimately consider them, but for us, I have 5 within my, my go-to bucket, 5 or 6 within my go-to bucket that I know, we're not going to waste time. There's going to be a probability of some success. There's going to be a term sheet if all looks good, we stick to those. We know that we'll do these opportunities, plain and simple.
I have a quick question to interject here, Joe. So far we spent a lot of time talking about the borrower. And I think for people who haven't borrowed in the past in these types of deals, what they don't realize is that there's a difference between like personal loans, like a mortgage or something on a house that you live in, versus like commercial loans when you're buying like a 60-unit complex and whatever. And one of the things is that the deal sometimes matters a lot more than the borrower. Right. So having an 800 credit score and some money in the bank doesn't guarantee that you're going to get the loan either. So what sort of standards are they looking for on the businesses?
Absolutely, Ryan. That's a tremendous point. Again, that's another thing when folks come to me. I mean, I can help pre-qualify borrowers, right? I get that question all the time. Can you pre-qualify me? What amount of a loan do I qualify for? It's not a home mortgage. We don't pull your credit. We don't look at your PFS and say, you can get $3 million. I mean, there may be some brokers that do that. And I can certainly engage and look at their information and try to help them understand what their sweet spot might be or their range of borrowing capacity. But you're right. These are business loans. The business is paramount. You are, the second piece of the puzzle here, and you and your strengths can be a risk mitigant. But in order to achieve financing to purchase a business, it is going to be about the historical financial performance of that business and its ability, first and foremost, to cash flow or debt service the loan that you are looking for. And again, another tremendous consideration is, what is the purchase price of that business, and does the historical financial data support that purchase price? We see a lot in this space that sellers of businesses may have an idea of what they feel their business is worth, or they've talked to someone that says, you can sell your business at 1-to-1 revenue. And when we look at the historical tax data, they may have played, the game for years and not reported as much to the bottom line, and now they want to exit. And we need to help folks understand, or I need to have conversations very often with sellers and especially buyers. Unfortunately, this person that has played the game and now wants to exit and hasn't reported all their income to the bottom line, when the bank has to do a valuation, or when we armchair evaluate that opportunity and we try to create enough cash flow, it's not adding up. It's not evaluating, in our opinion, or to the bank's opinion, to what that seller may feel the business is worth. So yes, it's very important when you're considering buying a business and you're thinking about utilizing debt or leverage. The way we evaluate businesses is going to be quite different than how an equity group evaluates it, how a cash buyer may evaluate a business. For us, it's going to be about that tax data, historical income, and does it support, that loan and that asking price.
Is there any way to get around, if a lot of these small businesses don't report taxes, like for instance, some of these cash-based businesses such as laundromats, et cetera, are banks willing to work with you on some sort of margin that they might anticipate that type of company has? Or is it really, here's the tax numbers and we'll give a multiple or a percentage of those numbers, but nothing else?
It's really going to be about what we can prove, because the SBA, they make it their job and their business if a loan ever goes into default, and you touched upon the very low default rates. But when they do go into default, the SBA will do everything in their power to avoid paying the guarantee to the bank in the instance of a loss. So if the bank has not verified income, if they've not collected documentation and they were to ever be audited on that loan, and they made that loan in absence of verifying that business has actually created that income, or if someone is committing tax fraud, so to say, and they've made a loan to somebody who's buried income or hidden income, that could end up getting the bank in trouble. So it's really, again, I've certainly worked on business acquisitions and worked with business owners where they're not reporting everything right down to the bottom line. But if we peel back the onion in their tax returns, they're not doing anything wrong. And we can find ways to verify the income. And we work on carve-outs as well. You might have a business owner who owns 5 businesses rolling up under one tax return, and they want to sell 1 or 2 of them. It is financeable. It creates a little bit more difficulty, but when we're talking about being able to verify things, there may be an extra step of using a third party, outsourcing finance company that can verify those numbers, or having audited financials or reviewed financials from a CPA. All those things can sometimes mitigate or be enough to prove what a business is making if they're just not reporting it all to the bottom line, or if it's not, in plain sight due to, some other factors rolling into somebody's tax returns.
Yeah, I wanted to dig there for a second with you too. So there's this whole thing on the seller's discretionary earnings too, as opposed to just profit, right? So we talk a lot about profit, but there's a lot of legal things that people do to not pay taxes on money that are going to show up in these businesses, especially probably in the smaller ones. I think you're going to see even more of it in like that 300,000 to 500,000 profit range, or even lower than that in the 100 to 250 range, where you've got an owner operator who's covering the cost of his car and his car insurance and health insurance and whatever. And that can be hundreds of thousands of dollars each year too, which would technically be profit, right? And those are things we can find that are legal to do and able to add back in, but aren't going to show on the bottom line as profit in some cases, right?
Correct. That's completely accurate, Ryan. And sometimes it does create difficulty for us. I mean, ultimately, I mentioned taxable income. I mean, effectively, we do work off of EBITDA. So we can add back discretionary things like we can certainly add back owner salary. We can certainly add back depreciation and interest expense. Now, when we delve into, your other expenses that are buried in your tax returns, if there's some one-offs, if there's some discretionary things or things being paid to outside parties that will not continue or not be on an ongoing basis upon the takeover by somebody else, sure, we can give credit to those. But again, it's going to be about what we can prove. Now, when we talk about the little stuff, and every business owner wants to claim, my travel and my vehicle and my this and my that, and every business owner is going to do it. The problem there is most banks, or pretty much any bank, is not going to go through the exercise of gathering all your gas receipts and your plane tickets and, performing a full audit on these smaller discretionary items. There's some consideration for them as bankers and evaluators underwrite these opportunities, but it's just kind of fluff. So if the majority of your EBITDA is being created by all the little things, that's not going to be as ideal for a bank, because they just don't want to go through the exercise of verifying it, of documenting it, of having it all in a file in case there were ever an audit. So we really want to stick to the obvious stuff, the provable stuff, and the little things, they're not going to hold as much weight, right?
That makes sense. Okay, talk to me a little bit. We were talking in the beginning about misconceptions and clarity surrounding loans. So can you talk to me about some of the major misconceptions that people have in going and getting financing from a group like yourself that we haven't hit on thus far? What else do people get wrong?
I think one of the biggest ones is, that SBA loans take a long time. We close acquisition loans on average in 45 days. And I'm talking, again, no real estate involved. You're buying, a business namesake, if you will. Our banks are pretty darn seamless when it comes to processing. And we do a lot of work on the front end, and we do a lot of documentation gathering and analysis and, cash flow evaluations and all that stuff out in front of actually approaching the lender. We almost pre-underwrite opportunities. The biggest thing about SBA loans is they're conventional loans, so they're document intensive, and it can be a daunting process. It can weigh you down. It feels like it's never ending. But if you're prepared and you're working with somebody who knows how to package these opportunities, who knows what to expect, who's going to lay it out for you, here's what's coming. Here's what your process is going to look like. Once we get through this, we're going to move on to that. You'll be fully prepared and you'll be in the driver's seat to move through a loan process quickly. It's important to work with SBA preferred lenders. That's another thing. Not all lenders that offer SBA are created equal. You want to work with folks that are preferred. That removes a 3 to 5 week process out of your loan closure. When the loan does not actually have to be submitted to the SBA for approval. So again, I think that's a real big one. I think a lot of folks, when they talk to other bankers or they talk to folks who went through an SBA loan process, or they worked with a small bank who was trying to figure it out the whole way along, they've got a really bad taste in their mouth about SBA and how long it takes and how difficult they are. The reality of it is, it's no different than any other conventional loan process that you would go through. You just need to, you need to know who you're working with and work with the right folks.
I like it. Well, crew, tell me what other questions you have for Joe also, because I'm definitely monopolizing this, although I'm happy to. Talk to me about where rates are at today, just given this environment we're in. And have you seen any tightening in loans given this environment?
Yes, definitely. So, acquisition loans, working with most of your top 10, top 25 SBA preferred lenders, you're probably going to be at the premium of a 6% rate. Now, in my 7 years experience working for MultiFunding, the lowest I've ever seen interest rates was 6.5%. The highest I've ever seen them is 8.25%. 8.25% was actually not too long ago, maybe a couple years ago. But right now the premium is at 6%. It is based off Wall Street Prime, which is currently 3.25%. And the bank will add a multiplier to that never exceeds 2.75%. So are there lenders out there that can offer you 5.75%, 5.5%? I've even had some regional small banks offer folks 4.75%. And I quickly tell them that, hey, if that bank can close that loan at 4.75% to purchase a non-real estate asset, you have my blessing. Go and take that loan. I can't compete with that. But again, most of your top SBA lenders, they're just going to price things at that premium of that 6%. And it is a variable rate. You're not going to find fixed pricing on a non-real estate asset purchase. The rate only adjusts when the prime rate adjusts. Again, that multiplier stays the same through the life of the loan. Another tremendous advantage, and when folks think about rate and you get sticker shock over 6%, or you're comparing, this to a conventional mortgage, you need to remember that there's no other conventional loan that offers a 10-year amortization to purchase a non-real estate asset. Literally, this is the most advantageous debt instrument that there is to purchase a business. Longer amortization equals lower monthly payment. This is a zero prepay penalty loan. They are designed for the average borrower to pay them off in 5 years. You pay the loan off in 3 or 5, 6 years, whatever. You're not riding it out for 10. Your effective interest rate shrinks significantly. It's a tremendous time to get SBA loans with rates being so low. And honestly, I don't think the prime rate is going anywhere for a little while, but I don't have a crystal ball, but we'll see what happens. But again, a very advantageous time to try to go out and get an SBA loan to purchase a business. Now, tightening of the belt, yes, this economic uncertainty, the pandemic has created a lot of losses for banks, right? There is going to be defaults, or there already have been defaults. There's businesses that aren't going to come out of this. They have loans with banks, and banks are starting to think about their balance sheet, or they're starting to think about, losses on those opportunities. A lot of banks got really heavy into the PPP loans, and they're waiting on that forgiveness to go through and be able to do all that and clean up their balance sheets. So you have a lot of tightening of the belt. In January, I closed a $3 million e-commerce business acquisition. My buyer didn't have a lick of collateral, no equity in his personal real estate. He did own another business, so he was seen as an advantageous borrower to the bank, but they got behind him. My banker and I were laughing 2 months later, saying that if that loan had not closed in January and had dragged out 3 more weeks, they probably would have backpedaled and tried to get out of the loan. Gone are the days of getting a $3 million, what we like to call airball loan, to purchase a business. So banks are, again, they're looking for risk mitigants. They're looking for stronger borrowers as loan amounts tick upwards. And hopefully, as we emerge from this and as we kind of get past all the craziness, you'll get a little bit of opening up again. A lot of banks who have completely moved away from doing business acquisitions, non-real estate related opportunities, they'll start to come back in the mix as well.
Yeah, this is really helpful. Thanks. A couple questions. Somebody asked sort of me privately here instead of the group, a couple things. Basically, she said, one, are SBA loans personal recourse? And 2 would be, why would I use a 6% loan rate if I have financing options elsewhere? So I'll let you answer those first, Joe, and then I can give my 2 cents.
Sure. Yes. SBA loans, again, they're conventional loans. They require personal guarantees. One thing it's very important to understand, SBA rule, when you, again, and I touched on this earlier, but I'll mention it again, not only do they require personal guarantees, but if you live in a state that doesn't have the Homestead Act, and you own real estate and you have more than 20% equity in that real estate, and you're purchasing a business that does not offer any collateral, again, it's an asset that cannot be liquidated by the bank in the instance of default. They will put secondary liens on your personal real estate. That means your home, that means investment real estate that you own personally, anything, any real estate that you own, they will put secondary liens on that real estate to help collateralize the loan. Do you need $1 million of collateral to get $1 million SBA loan? Absolutely, positively not. And again, offering collateral or having significant equity in real estate can be a risk mitigant on larger loan opportunities or riskier loan opportunities. So if you don't have any real estate, you can certainly still potentially qualify for an SBA loan. But again, the more risk associated with an opportunity, that's not going to help you as a borrower. Trying to minimize your equity in your real estate by running out and getting a HELOC. I've certainly had folks do that before. You're not really helping yourself. I think most folks need to be comfortable with, personally guaranteeing, and if they own that real estate, okay, I'm putting it all on the line to be able to get one of these loans. Now, the question about if you have options, it's kind of a broad question. I don't necessarily know what those other options are. I mean, if we're talking about other debt options that are lower than 6%, my question to you would be, are they putting a squeeze on you elsewhere? Is it a 10-year amortization, or is it a 5-year amortization? Is it a 90% loan to value loan, or is it a 75 or 80% loan to value loan that you're being offered? If it's less than 6% and it's the same parameters, because there are certainly SBA lenders that will do, like I said, they will offer slight discounts to given borrowers, or in certain situations, they may do less than 6%. And I would encourage folks that if you can find a good SBA preferred lender and you feel comfortable with their ability to get the loan done, and they're offering you some tremendous pricing, by all means, you need to exercise that option. But if we're weighing things like equity, or if we're laying other outside resources where we're trying to compare, a 100% ownership takeover of an acquisition of a business by utilizing an SBA loan at 6% at 90 LTV over 10 years versus, having to shell out portions of your business at what seems like a lower rate or a lower cost. I mean, you need to think big picture. If you're willing to delve out your profits long term to be able to use other people's money, then maybe that is the best option for you. But if you want, a business to be solely yours and you want this very affordable loan, that's why it's a tremendous option for a lot of folks.
Yeah, I agree. The only thing I would say is, so I'm a private equity investor, so I take people's equity all day long, right? I take people's equity in micro PE businesses and across other industries. And it's interesting because a lot of people think about my capital as having a very low cost of capital, because I don't require any sort of interest rate or payout on a continual basis. But the reason we make so much money is because equity is actually really expensive. And so, it's just something to, and this would be even a disadvantage against me. I would happily loan out, but I would be a higher rate than 6% by quite a long shot if I was to do this on a small business perspective. But I would happily loan out money, at these rates for a couple year period. But equity is really expensive. So just remember that, especially how I do this, if I buy these types of businesses, is, when I'm trying to buy a business like this, you just have to model out your payback on the loan inside of, your expectations for what the business is going to make. Because to Joe's point, I'm never probably going to get a loan and use a 10-year 6% interest rate on a business that does $2 million and just a couple $100,000 in profit. I am definitely going to prepay that loan, and I'm going to look for sort of a timeline that's usually 3 to 5 years to pay that off, so that by the end of it, I own 100% of the business, and all I did was use future cash flow to pay off the loan up front. Where you got to get a little be a little particular, is just making sure that your expectations are reasonable enough, because, that loan has to be paid, every single time, and you have to have that as part of your equation. It could hang over your head if you don't do the due diligence, right? So I think that's smart. Ryan, were you going to ask a question?
Well, no, I was just piggybacking on what you just said. I mean, I think that is one of the most important things, and it's one of the reasons we talk about looking at things just based on multiples of profit, right, as opposed to just revenue or whatever other ways you would use to figure out what the business is worth, future growth, all those things. We don't take those into consideration, and they're not going to in the SBA loan either. So the thing that we would want to consider is, if we're saying, okay, there's enough profit here, if things just stayed the same, that we know we could pay it off in, say, 3 years, and it's on a 10-year note, you've given yourself the cushion that in the down month, you're not going to have to come up with 3 or 4 times the payment in order to cover it. on a shorter term note like you would need to. And then at the same time, like you said, you're effectively pushing down your interest rate by paying it off faster over time. And then if you add in like the 3M model that we talked about, which are what other markets could we be in, what marketing are they not doing, like where are the other things that are not being taken advantage of in the business? Because most of the businesses that we're talking about is how could I actually impact the business so that it creates more income, right? Then potentially even opens up opportunity to pay it down even faster. And so I think that we also talk about other strategies, right? SBA is not the only one, but it is one. And I think for people looking at structuring, it'll be cool for people to see the one that we put together the other day, Codie, for people to see how they can combine these things. How do you combine seller financing with SBA? And how do you take 50% of the value as SBA instead of 75 or 90 or whatever, based on what you can do with seller financing and what you have putting into the deal yourself?
Yeah, that was perfect. That was my next question. Like, Joe, what do you think?
I'll add, Codie, just very quickly. I mean,
please.
The top SBA preferred lenders, they don't even require like a depository relationship. You could bank with whomever you want. Every month, your loan payment is going to come out of your business checking, and you're going to hear from them once a year to make sure that things are on the up and up. They're going to ask for your tax returns. Make sure that you've not made material changes to ownership, something that would affect their filing of the loan with the SBA. So, when you think about utilizing debt and getting an SBA loan, you're never going to have to answer to anybody. Your projections or the way you thought about this business and presented it to the bank and got through underwriting and got the loan approved. Once the loan is closed, the business is yours. You answer to nobody but yourself. Plain and simple. That's another kind of beauty of I guess using debt, using leverage for these types of opportunities.
Yeah, agree. No dilution and no having to theoretically, go out and restructure cap table or deal with I mean, yeah, I understand the difficulties of dealing with investors. I got a lot of them. So one of the other questions I had for you, Joe, was let's talk about, stacking of financing. So, I know that, like, of course, for you, it'd be great if they did all the loans specifically through you. But, what are you seeing the most creative and the smartest people do to finance businesses? Are there things that are you seeing people use equipment loans on top of SBA and seller financing? Like, what's the right sort of sauce or combination that you think makes sense? Or what are some creative ideas that you've seen?
When it relates to stacking, you have $5 million of borrowing capacity with the SBA. When business acquisitions or business opportunities are beyond $5 million, we have a multitude of lenders who will, do pari passu conventional lending alongside your $5 million of SBA. So we can get beyond $5 million.
And explain what pari passu means for those people, which means equal, essentially.
It's basically just a side by side. You have your SBA loan in a first position. You have this conventional loan through the lender that they service on their own, alongside or on top of your SBA loan, and it's still under some very favorable terms. It may mimic the 10-year amortization. It may be a little bit shorter. Typically, it's a little bit short. It's written more like a standard conventional loan, but that's how some lenders can get creative going beyond your borrowing capacity. So I also deal with serial entrepreneurs. They want to hit their borrowing capacity with SBA. They want to buy a multitude of businesses. That's fine. It is a revolving $5 million. It's not a one-time thing. As you pay down your loans, your borrowing capacity opens back up. And I think it's important to understand that when you get one SBA loan, you've now put yourself in the driver's seat with that bank, with that lender. Who's going to be the first person to jump at the opportunity to work with you again? It's much more favorable to go back to your existing lender that has liens on your house and, as your personal guarantees and liens on your businesses. Well, now we want to buy this business. Will you work with me again? Versus having to go to another lender and them having to sit secondary behind that other lender that already made you the SBA loan. So, very quickly for good borrowers who look at good opportunities and want to build out a nice portfolio of businesses, or, if you using laundromats as an example, you own 3, you want to add 3 more, you'll have banks that'll jump at the opportunity, especially if you've been positively servicing your debt and you're creating nice income and your businesses are on the up and up. They're going to jump at the opportunity to work with you again. So that's another good thing to understand. It's not a one and done situation unless you just run out and you borrow the $5 million all at once.
Yep. And so I like it. So what about, I think it's smart because where you do sit in the capital stack is so important for anybody who's lending to you. And that actually can be a huge hindrance if you don't establish good relationships where they're okay being, further down in the capital stack. I mean, typically, if I'm a lender, I want to know who else has any sort of lien on your business before I would give you a dime. And so I do think that's a really important point. What about timeline? So sometimes, the deals are hot, right? And people need to close on something quickly. And so, one of the things I liked about when we spoke and some of the people that have worked with you before is, you talked about speed to close. So can you talk about expectations on timeline and how quickly can you close some of these deals?
Sure. My process is this, original engagement, I like to have a conversation. I like to get to know people. And then, answer any of their questions, talk about a process, and then very quickly, immediately after that conversation, move to gather pertinent information. I certainly respect that business acquisitions, timing is of the essence, right? Sellers don't want to wait around, especially when you're dealing with getting a loan. They don't want to hear, most of them don't want to hear that to begin with. So the last thing they want to hear is you're going through some getting pulled through the mud and you don't know where you're at with your loan process. That's something that we always help people avoid. So again, I gather all pertinent information from our borrower or borrowers, okay? And I gather pertinent information, financial information on the target business. And we build out a file. I don't pull anybody's credit. I don't apply with anybody on your behalf. This is for my analysis, for our discussion, good, bad, otherwise, and we very quickly, within a day, we're delving into the opportunity together upon my receipt of all that pertinent information, okay? And again, I talked about just touching on engaging with people. If they don't necessarily have a target business, it may be good, if you're shopping or you want to have that ability to jump at something, engage with me early, allow me to review your information and help you understand what your borrowing capabilities are going to be, and then work on the business from there. We've already built out half of what we need. So when you do identify an opportunity, we grab that and we hit the ground running. So my initial analysis, I usually like to turn that around within 24 to 48 hours of everything that I receive. I then take my loan analysis, my loan write-up to my preferred banks that I choose that I think would be interested in the opportunity. That's 1 or 2, 3 if need be. I usually get their feedback within sometimes same day. If I catch them on a good day, sometimes it may take me, a business week, but my guys are pretty good, and I do all that work out in front for them. So it's easier for them to analyze an opportunity. If they have questions, they'll come back to me with those, a few questions, concerns. If they feel like it's a good opportunity for them, I get a proposal. My bankers do not like to issue me term sheets or proposals if they do not feel they can get the loan approved in underwriting. Again, another thing that we do very differently. A lot of banks out there, especially big name banks, you could call them on the phone, tell them your opportunity, and you have a term sheet in hand, okay? A term sheet is the furthest thing from a guarantee to lend. It is merely a proposal, it's non-binding, and again, our banks don't like to hand those out without some meaning behind them, without some worth behind them. And again, we're very transparent. I mean, if my lender identifies something that they do like, they don't like, they're going to share that. We're going to talk about it. I'm going to be sharing all that with the client. Now, once I get a proposal, which usually happens within a week, give or take, if you like what you see in front of you, and again, I've pretty much set expectations within this call. But if you like what you see in front of you and you feel comfortable, you sign it. Again, it's non-binding. All that does is move us to the next step, which is underwriting the loan opportunity. You're going to get a short list of additional needs, some of them for the seller, most of them for you as the borrower, bank documentation, application, all that stuff. We get that all over to the bank. Now underwriting happens. Again, typically within a 1 to 2 week window, we are actually getting to a loan decision. So either a yes or a no. And if we done what we're supposed to do out in front, we bat a very high percentage on getting those yeses. Okay. I don't like to end up with no's. And again, my lenders don't like, or my bankers don't like to issue proposals to end up with a no. So the hope would be that we've done everything we were supposed to do, and within that 2 to 3 week window, we actually have a decision on the loan. And hopefully it's a yes. From the time of that yes, that approval to a commitment to the actual loan closure is usually a 3 to 4 week process. You have all your third party processes that need to happen, the business evaluation, which usually takes about 2 weeks, gathering all your entity documentation, getting your life insurance, assigned to the lender, all the third party stuff that's going to happen in that 3 to 4 week window. So usually I would say on average, again, I close these loans in 45 days. I've done them in under 30. I've done them in longer than 6 months. How quickly we're able to move is going to be dependent on you and a little bit on your seller. How swiftly and how well everybody's on their P's and Q's. And again, my banks are pretty darn seamless when it comes to churning these things out. It's the same process every single time. So as long as you keep it moving, as long as there's no hangups, then we should be able to move through that process in an average of 45 days. It looks like Natasha just asked a question, about life insurance. Yes, the lender, the SBA actually requires that you have a policy or a rider to your policy that assigns a lost payee to the bank if you, God forbid, were to ever pass away, to cover the entire amount of the principal amount of the loan. So you will need to get a life insurance policy to cover a total loss on that loan. And you will need to have business insurance. I typically like to tell folks, whatever insurance policies that the current owner of the business has, unless you're going to make some extraordinary material changes, like maybe you're going to run the business out of your home or you're not going to have any employees, you're probably going to need the same exact insurance that they have on the business as well. So hopefully I answered your question, or maybe even more there, Natasha.
So real quick, Joe, a follow-up to that. So if they just added a 10-year term life insurance rider just to cover the amount of the loan, they can do that. It doesn't touch any of their other life insurance stuff.
That's right. They just need to add, you can assign your policy, you can add an additional policy. It's really up to you. But yes, there will need to be.
And to clarify, because I think it sounds scary when you say assign your life insurance policy. So all of this, remember, is you don't have to over collateralize the loan. I mean, they're going to want what the loan is worth, and they're going to want to make sure you don't die, because if you die, you can't pay. And you really want to have that same assurance too, because you want to make sure that this doesn't fall down, to somebody else in your family if you have this sort of instance happen. So when he's listing off all the things that you can use as collateral, those are options. It doesn't mean that, I need to give him all of my entities in order to backstop this. So this is part of the negotiation that you use also as well with deciding which banks require what collateral. And again, there is variance depending on which ones, but it's better to know sort of all of that up front.
Yeah, I mean, there's a few things that are SBA rule, right? So you can't negotiate SBA rule. I mean, if you're going to get one of these loans, you just have to stay within the rules and regs of the SBA. And, the collateral and the life insurance, those are SBA rule. So just, setting expectations that those will be required, no matter whom you work with. If they are doing the loan as an SBA-backed conventional loan, those will be required. And honestly, I've done acquisitions without SBA backing, and I'll tell you, the lenders want to take the same stuff, that the SBA does. They want your home as collateral if you're not buying real estate. They want you to have life insurance, to cover the principal balance in the instance of, your demise. So it's pretty standard.
It is. But the only thing I would say for everybody to remember is SBA and loans in general are not the only option. So when we talk about negotiating, he's 1,000% right. He's an expert on this space. But also remember that you can negotiate some different aspects with the seller. And that's where you can get really creative with what you can or cannot put down. And you can also get really creative with some alternative fundraising sources. So this is where other people's money come in. If you don't feel comfortable putting, I don't know, all of your real estate property into it, and you want to get down the total cost that you have to get from the SBA. So there are lots of different levers to pull, but that's why when you do this, when you start to do this deal, you realize, where are the guardrails? Where can I absolutely not mess around? And, that is typically that 10% down-ish. And to Joe's point, some of the collateral mandated. But remember, you can always change how big of a loan you take out. So then your collateral becomes a whole lot less, and you maybe aren't as stressed about that. Okay, so I think that's all the time we have. Ryan, anything you want to close on? Joe, thank you so much for doing this. You were really helpful, and I appreciate you helping all of our buyers.
Just one last quick question that I think Joe will be able to answer super fast is, what are the things that they should be going to their seller asking for upfront immediately if they know that SBA is going to be part of their purchase?
If you can get it from them right off the bat, 3 years tax returns and current year financials as late as you can get them. So September's over. If people are good with updating their QuickBooks, get them through the end of September, especially now more than ever. Banks want to see as current of financials as possible because the SBA themselves have put a lot of rules in place surrounding COVID and the effects it's having on businesses. So banks are being kind of demanded that they get very current financials. So, a lot of times sellers are hesitant to give you tax data. They want you to sign an LOI or make an offer. Same thing on that side of the transaction. Those LOIs are, sometimes can be meaningless. So if you need to enact one of those to get some tax data, that's going to be your most pertinent information. Don't just ride it out on in-house financials and expect you're going to get a lot of consideration on a loan that way. Okay.
Definitely agree. Don't buy on those either. Okay. Well, thank you, everyone. I hope this was useful. Thanks for joining us. Joe, you're the man. And if they want to get in touch with you, we'll put his contact information in the Facebook group so anybody can reach out to Joe. And he's also listed on the MultiFunding website, which is listed in Facebook as well. Thank you so much, everyone.
Yeah, thank you.